Hello, everybody. Welcome to the channel. On this one, we're going to do something a little different. I want to do a more in-depth look at the differences between SCHD and VOO, and basically which one is better to put money into. Instead of sitting here fighting with it, trying to do a whole bunch of research and things like that, I decided to check out somebody else's video, see what some other people are saying. Special shout out to InvestWiseJourney. Your video has been selected for today. Link to his video will be below. Spoiler alert, I feel like you can't lose either way. Both of these are quality stocks. As long as you come up with a plan and what you want to do, I think you can't lose. If you're somebody that's new, one thing I think that's very important is you have to decide what kind of investor you're going to be. Are you going to be an income investor, someone who buys stocks that generate money, usually in the form of dividends, or are you going to be someone that's looking for capital? You just want the stocks to grow as they are. And at the end of the day, you'll have all this money that you'll have to pay the taxes on after the fact. Probably the biggest plague that hits new investors is the FOMO. You buy stock because you saw it online, it looks great, do very little research on it, and then all of a sudden, what happens then? A week later, some other stock is doing great. And you think, oh, I should have put my money into that. Maybe you sell the stock you bought originally and go put it into something else. I think this is a mistake. Chasing the market is a losing effort. I want to say something like 90% of investors that go this way, they always end up losing. You may win the first time, you may win the second time, but eventually you're going to buy something at the high and watch it crash and burn. And then unfortunately, most people then end up selling at a low point. Instead, I would recommend you do some research and decide what you want a stock to do. If you buy into a stock because it is an income stock and it continues to provide you income at a rate that you find to be decent, then stick with it. There's no reason to sell it. Just because some new stock pops up that's the new hot thing doesn't mean you should sell your original stock. As long as it's still doing what you intended it to do. If you get some new money, you want to throw it at the new stock, totally fine. But stick to your plan. Keep that going as long as it can. If all of a sudden you were hoping for income, it's no longer generating income, totally fine. You want to sit there and pivot to something else, do a little research and then do your pivot. It's never really a good idea to FOMO into anything. Now let's get over to this other video.
Most investors think they know which ETF is best for long-term growth, the one that's always dominating headlines. But what if the truth about how a $100,000 investment grows in VOO versus SCHD isn't what you expect? You might be missing out on a strategy that better fits your financial future. You put $100,000 into VOO or SCHD. Which one actually grows more over the long term? That's the core question.
Gonna pause it right there. I totally agree with a comment he just made there. It's a lot of times these videos kind of point you to one or the other, and people kind of get that locked in their head like, oh, I need to pick this one. I need to put all of my eggs in one basket. And all of the very famous, very rich investors, they all have diversified in one way or another. Some stocks, such as VOO, are essentially a diversification because there are so many different stocks in there. Same with SCHD. But a lot of times, you can come up with your own strategy. Maybe say, I want 500 shares of SCHD and I want 300 shares of VOO. You can come up with a plan right now and write it down and try to follow that all the way into the end till you reach a certain number. One thing I don't like about these videos a lot is they talk about things like if we put $100,000 into this. Most people starting out aren't going to have $100,000. You might have $10. You might have $100. May have $1,000. But the point is, you can do fractional shares and work your way up to that $100,000 if you so choose to.
Many wonder if the growth focus of VOO always beats the dividend stability of SCHD. I'll break down the specific factors driving their performance differences. This isn't just theory. I've analyzed over a decade of real historical data and run a direct $100,000 backtest. Get ready for a clear, data driven comparison of these two investment giants. All right,
One thing that's always important to note, anytime somebody on a video says they've done a back test, basically what that means is there are historical facts on how much a particular stock was at a certain price at a certain time of day that are recorded throughout history, more or less. So there are tools out there that allow you to back test, which is basically say, if I had X on this day and I held it until Y, what would my money, like what would have been the end result? If I kept the dividends, if I put the dividends into it, like you can do a lot of scenarios. But really, the main thing to remember is past performance doesn't necessarily lead to the future. So just because 10 years ago, if you put money into XYZ and it tripled your money doesn't mean that 10 years from now, if you put in that same amount of money, that it will triple your money.
let's talk about VOO. Many investors see this ETF as the go-to way to get broad exposure to the US stock market, and for good reason. Imagine the S&P 500 index as the ultimate scorecard for America's biggest companies. It's widely recognized as the main measure for the US stock market, tracking the investment returns of 500 large US companies. When you hear about the market's performance, they're often talking about the S&P 500. The Vanguard S&P 500 ETF, or VOO, is built to simply match that S&P 500 index as closely as possible. It's a passively managed fund. This means it just buys all the stocks in the index, in the same proportions, without anyone trying to pick winners or losers. This strategy
So I think this is pretty important. Anytime you pick a stock, you need to understand basically what you're buying. If you're buying VOO, you're buying a very balanced stock. Like it says, it's basically the 500 largest US companies. If you want exposure for overseas or international, you're not going to get that in this fund. So it's very important for you to understand what it is you want. And for something like this, you can see the proportions are all the same, passively managed. That being said, other stocks sometimes do outperform it because other stocks may say, well, instead of having all these things equal, I want more into stocks. Like you hear about Nvidia and AI and some of these things really exploding. A different stock may have more weight into those areas. But guess what? When those areas go down, something like food that is much more well balanced will not drop as fast. So there's always a little bit of give and take.
is super efficient if you want to capture the overall market's growth. One of the coolest things about VOO is its incredibly low expense ratio, sitting at just 0.03%. That's practically nothing, meaning more of your money stays invested and works for you. It also manages a massive amount of money, over $1.3 trillion, with the ETF share class accounting for $608 billion. This huge size ensures it's easy to trade, so you can buy or sell shares without issues. When you look inside VOO, its holdings really show how the S&P 500 is structured. As of June 2025,
One thing that's important to kind of know about VOO, or it's good to see, is this $1.3 trillion. So if you don't know what this means, this basically means this particular stock, this fund, has $1.3 trillion that they are managing. So they don't just have your money, they got my money, they got your cousin's money, they got the business hedge funds. Everybody is essentially trusting VOO. Um, it's very well known, very well trusted. It's one of the top stocks like that are out there. If VOO goes down, that essentially means either A, the whoever was over the fund has just, I don't know, gambled away all of that money. I don't know how you could lose $1.3 trillion dollars. Or B, America is in big trouble because that means the 500 largest stocks, not only are those bad, but there basically are no good stocks because if those, let's say those 500 dropped, another 500 should essentially take their place. But if all of, like, if there's nothing good, then the price of the stock would fall. I think this is also pretty important to see. So when I talked a little earlier, I mentioned about having diversity in your stocks, but What does that really mean? What it really means is having diversity in the type of stocks you have. You can have multiple stocks with different ticker symbols, but if they all have the same stocks in them, the same things building out the ETF, then you don't really have diversity. And the main way people view this is between what categories they're in. If any one category happens to drop, and that's all your stock's made out of, then you're going to get crushed. So looking at this scenario, information technology 31%. It's mainly because if you look at the big 7 or the magnificent 7, they make up a huge chunk of the market cap at the top of the US market. And guess where those all are? They're all in the US and they're all at the top of the list. So 31%. A lot of IT companies have pushed their way to the top. So if let's say there's a huge AI bug that comes out and everybody loses trust in AI, if your portfolio is essentially a third IT, you're probably going to get crushed. I mean, I hate to say it, and I don't really think that would happen. There are so many security companies out there like fighting against things like that. But if it were to happen, you could absolutely get crushed. So even though something like IT may give you a ton of growth, it's often not a good idea to put everything into the same category.
Percent is in information technology. You'll also find significant allocations in financials at 14.39% and healthcare at 10.84%. This heavy tech weighting has been a major driver of the S&P 500's returns lately. Its top holdings are exactly what you'd expect. Giants like Apple, 6.75%, Microsoft, 6.22%, and Nvidia, 5.64%. This means VOO's performance is really tied to how well these big tech companies are doing. Now, let's switch gears and talk about SCHD. Many investors, especially those looking for a steady income stream, swear by dividend ETFs. Is SCHD that reliable, consistent choice you might be looking for in your portfolio? The appeal of dividend investing is huge. Imagine getting paid just for owning a stock, and then using those payments to buy even more stock. SCHD aims to track the Dow Jones US Dividend 100 Index. Unlike VOO, which focuses on broad market cap, SCHD is all about quality dividend paying companies. Its underlying
All right, I want to stop it right here. So, he just said something that's pretty important to understand. So, VOO is designed to be a growth stock. It's meant to be something where you buy it one day, it's at 500. You look the next day, it's at 510. You look a month from now, it's at 550, 600, 700. It's meant to grow like that. SCHD is also designed to grow, but there's a much bigger significance and a much bigger part of the plan that's about a dividend. So you might be wondering, what's a dividend? A dividend is essentially a reward for owning part of a company. If you own a stock, you own part of a company. I wouldn't recommend going into the Apple store and say, hey, I'm part owner of Apple. But you know what I mean? You own a part of the company. So therefore, when they choose to pay out all of their investors, you get some cut of that. One of the big things about SCHD, which I don't remember if he talks about too much in this video, is their dividend growth. So there's something called a dividend snowball where you buy stocks that then give you dividends, use those dividends to buy more stocks, which then create more dividends, which you can use to buy more stocks. So it's called a dividend snowball because it's something that starts small, maybe getting 25 cents, then 30, then 45, then 50. It really just grows and grows and grows.
index selects US companies that have consistently paid dividends for at least 10 years. But it's not just about paying dividends. SCHD also screens for financially healthy companies using factors like cash flow to total debt, return on equity, ROE, dividend yield, and 5-year dividend growth rate. This screening process helps avoid what are called yield traps, companies that offer high dividends but might be in financial trouble. Just like VOO, SCHD has a very low expense ratio of 0.06%.
I think he just said something pretty important there. He mentioned when he was talking about the way they pick stocks that they look for a 5-year dividend growth rate, but also make sure something's not a dividend trap. There are stocks out there that if you just sort by dividend, you will see these huge numbers in them. Usually, the bigger the number, the more scary it is. Because at some point, it's not so much that it's paying out these huge chunks of money, it's that it's basically paying you back your own money. And that's what you don't want. You want the company to be generating money and then paying you something back.
High dividends, but might be in financial trouble. Just like VOO, SCHD has a very low expense ratio of 0.06%. While slightly higher than VOO's, this is still incredibly competitive, especially considering the more complex, rules-based screening it uses. SCHD also has a substantial amount of money under management, around $68.2 billion as of early June 2025. This shows
So you see 68 billion versus I think it's 1.3 trillion. So much smaller overall, but 68 billion is nothing to blink at. That's a lot of money.
strong investor trust in its dividend strategy and ensures good liquidity. When you look at SCHD's portfolio, it's quite different from VOO's. As of June 2025, it leans heavily into more traditional and defensive sectors. Consumer staples makes up 19.4%, energy is 18.9%, healthcare 14.5%, and industrials 13.3%. Its information technology exposure is much lower at just 8.9%. This allocation comes directly from its focus on steady, dividend-paying companies. Its top holdings include well-known names like Coca-Cola, 4.29%, Verizon Communications, 4.28%, and Cisco Systems, 4.28%. This distinct profile means SCHD might offer more stability in certain market conditions, but it could lag during periods when tech growth explodes. We've looked at their
All right, so this is kind of what I was talking about a little earlier, right? Technology basically, at least for the US, is a huge growth. A lot of times it goes above GDP. It's the fastest booming thing. It's AI, all that kind of stuff that you always hear. AI security, um, AI security, storage, cloud, all that kind of stuff that's kind of the hot topic type things. Those all fall into technology. So SCHD, because of the way they screen for stocks, for the way they look for dividend stocks, the way they look for people that have been paying consistently over the last 5 years, they will sometimes not include some of those bigger stocks that have all that growth because it doesn't meet their goals. Their goals are for dividend growth. And because of that, these two basically have two completely different strategies.
periods when tech growth explodes. All right, let's stop talking theory and get into the real numbers. What does the actual history tell us when VOO and SCHD go head to head? Basically shows how much your investment would have grown each year on average, assuming you reinvested all gains. Over the past 5 years, VOO has posted a compound annual growth rate of 15.90%, while SCHD delivered 12.23%. If we stretch that out to 10 years, VOO's compound annual growth rate was 12.82% compared to SCHD's 10.58%. Since inception, VOO, which started earlier in September 2010, has a compound annual growth rate of 14.25%, and SCHD from October 2011 shows 12.23%. This clearly shows VOO has historically delivered a higher compound annual growth rate across these periods. This outperformance largely comes from the strong run of US large cap growth stocks, especially in tech, which VOO is heavily exposed to through the S&P 500. So, you've seen the historical performance, but what if you actually put your money on the line? Imagine this. It's October 20th, 2011, and you've got $200,000. You decide to split it, putting half into VOO and half into SCHD, and just let it ride, reinvesting all your dividends. How would those investments have grown over the next almost 14 years? If you had invested that initial $100,000 in VOO, your investment would have grown to a final portfolio value of $635,000. That's an overall total return of 535%. Now, if you had put that same $100,000 into SCHD, your final portfolio value would have been $485,000. That's an overall total return of plus 385%. Looking at those numbers, VOO clearly generated a significantly higher final portfolio value over this specific period from late 2011 to mid 2025. This reinforces what we saw with the compound annual growth rate figures, highlighting the strong performance of US large cap growth stocks, which are the primary drivers of VOO's returns. Even with SCHD's consistent dividends being reinvested, the capital appreciation from VOO's holdings was just stronger during this time frame. This shows a common trade off in investing: the potential for higher overall growth from a strategy like VOO versus one geared towards higher current income and dividend sustainability like SCHD. Interestingly, when the market hit its sharpest downturn during the COVID-19 crash, both ETFs experienced very similar maximum drawdowns on March 2020. VOO dropped by 33.99% and SCHD by 33.37%. This suggests that during such extreme, sudden market shocks, SCHD's dividend and quality screens didn't necessarily offer substantially more downside protection in terms of peak to trough decline compared to broad market exposure. However, remember, their performance in other less severe downturns or different market conditions can vary significantly. Okay,
So he said a lot there, right? And it's it's difficult to kind of say. So one thing he kind of showed is that from a growth standpoint, VOO is definitely the winner. VOO ran away with the numbers. I think it was what 200K more. Yeah, here we go. Um, Quite a bit more, like 170K, 200% more as far as the total returns and all that, right? There's a problem, I believe, with these numbers, and I'm gonna need to go and look myself to verify. But the main problem is he's looking at 2011. One thing that I don't believe is being considered here, I believe these numbers, well, it's being back tested. This is what those numbers would have been back then. The advantage of SCHD over VOO is the dividends. Now, he has mentioned it as sustainability, which is true. They're looking for quality stocks that are able to maintain and sustain their dividend, but they're also looking for growth. They have been able to grow their shares, or sorry, they have been able to grow their stocks pretty consistently over the last couple years. So even though that may have been true back then, I would actually guess that with the continued dividend growth, that SCHD may have actually been able to close this gap quite a bit. And moving forward, may be able to even surpass it, just simply off of the fact of them raising their dividend year after year after year. One thing I wanted to say really quick about here, so he was mainly talking about this huge crash that happened. And if you look at it, the price of SCHD was $18 at the time, and VOO was 294. So, I mean, these two stocks were kind of in two totally different places in the world, if you will. And granted, like he said, there really wasn't too much difference in the two. The difference you might have wondered about really probably came from SCHD having dividends. For the most part, as long as a company is sustainable, even if their stock price goes down, they will still pay a dividend. If you were down here and you were the VOO person, and let's say you had to pay some bills, you had to sell portions of your portfolio to keep paying those bills. If you were the SCHD person up here, those dividends probably didn't change. They probably stayed the same. You were able to pay the dividends, keep your stock, and then ride it back up. The VOO person had to sit there, drop down, sell at the bottom, and then start to ride back up with what was left. That's really one of the main problems with just being the growth person. Because when you're ready to retire, you need some way to pay things without eating away at your overall portfolio.
3.99%, and SCHD by 33.37 didn't necessarily offer substantially more downside than SCHD, compared their numbers, and seen what makes them tick. But the ultimate truth about these two ETFs isn't just about their individual performance. It's about understanding which one genuinely fits your specific stage of life and financial goals. A common mistake many investors make is looking for the one best ETF for everyone. They might hear VOO had higher past returns and think it's automatically the default, or that SCHD's dividends make it universally superior. But here's the truth I promised. For most investors, especially those with a long time horizon, VOO often represents a better core pick for broad market diversification and growth potential. Its superior historical total returns over the last decade highlight its ability to capture the market's overall upward trajectory, driven by leading US companies. On the other hand, SCHD is generally a better pick for investors closing in on retirement, or those who prioritize a higher current income stream and a degree of stability. Its focus on financially sound, dividend-paying companies results in a more substantial dividend yield of 3.92% and can lead to significantly smaller losses during certain market downturns. While its total returns might have lagged VOO over the specific period we analyzed, its emphasis on quality and consistent income can be invaluable for those in or nearing their income-generating years. But the real secret to maximizing your returns isn't about picking one of these fantastic ETFs over the other. The most effective strategy is actually to build a powerful, well-diversified portfolio using several ETFs, leveraging the unique strengths of each.
So I believe I mentioned this a little bit earlier, but it's important for you to understand kind of what your plans are and to build things around that. There's absolutely nothing wrong with having multiple stocks, not feeling like you have to put everything into one, actually changing your plan over time. But it needs to be a plan. It shouldn't just be FOMO, you following something, you heard Jim Cramer online saying something. I mean, it's not financial advice, but I don't see a reason why you can't have both of these in your portfolio. Actually, I think that is financial advice. All right. I don't want this video getting too long, but I just wanted to kind of finish up my point here. So this is Seeking Alpha, pretty good website. I don't have all the bells and whistles on, but it still does a good job at showing you some things. And one thing I want to point out here is the dividend growth that I was mentioning. So as well as just having the general price of something grow, you have to look at the dividend growth. As you can see here, SCHD basically has a 3-year growth of 8.19, 5-year 10, 10-year 10. So it's been pretty consistent. You come over here to dividend growth and you can see 2020, 68 cents. So that's basically for the full year. If you had one share, it was paying you 68 cents. 2021, 75 cents, right? So it's like nine. So it went up like 7 cents. Then you come over here, right? From 75 to 85. So it went up about 10 cents, right? You go 2023, 89 cents. Come over here, 99 cents. So the point is, every year this is going up, I don't know, 7, 8 cents. So if you sat there and you just, I don't know, what was it, 14 years every time out? So basically, this price, this dividend that you're getting, theoretically should be closer to $2 when it's all said and done. And you see some of these are a little bit higher here. And the fact is, it's not just growing like at the same amount. It's usually going up a little bit higher, a little bit higher, a little bit higher. So the fact is, this would allow you to buy more shares and also should allow then for your position to grow, assuming the price of SCHD can also go up. So anyway, long story short, I agree with 90% of what InvestWiseJourney has said. I'm going to put his video in the comments below so you can check it out. I like this. Finally, someone not pimping SCHD. He failed to mention during SCHD still produce dividends, which is huge for retirement. This is something I mentioned. That's what I was talking about. When things fail, if you had SCHD or something that had dividends and it never stopped, you were in a much better position. I definitely think you should have both. If you only had two shares, then these would probably be the two. Anyway, in case you didn't know, I's a hobo. Put a comment below. Put a comment below. Let me know which one of these you prefer and if you think people should have both. Or maybe you just like one or the other. Let me know.